Something just changed in the U.S. crypto regulation that matters more than it looks. After years of uncertainty, Congress is closer than ever to establishing a comprehensive legal framework for digital assets, and the outcome could influence how institutions, regulators, and companies approach crypto for years to come. In the next few minutes, we'll break down what actually matters and what's actually inside the Clarity Act, why one political dispute could determine its future, and why many believe this legislation could reshape the environment for Ripple, XRP, stablecoins, and the broader crypto market. For more than a decade, the crypto industry has faced the same fundamental problem. The technology evolved faster than the rules. Companies built billion-dollar businesses without knowing which regulator had authority. Developers wrote blockchain software while questioning how existing financial laws applied to their work. Investors watched enforcement actions unfold before clear regulations were ever established. Now that could finally be changing, ladies and gentlemen. See, the Clarity Act is one of the most comprehensive crypto bills ever introduced in the United States. At more than 600 pages, it doesn't focus on a single issue. It attempts to define the legal framework for nearly every major part of the digital asset industry. And that's why this legislation deserves attention, because this isn't simply about crypto regulation. It's about whether the United States is finally moving from years of uncertainty towards a system that businesses, financial institutions, and investors can actually operate within. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the market. What immediately separates the Clarity Act from previous propositions and proposals is its sheer scale. At more than 600 pages, this isn't a narrow amendment or a temporary solution. It's an attempt to build an entire regulatory framework for digital assets. Rather than addressing just one issue, the legislation tackles nearly every major question the industry has debated over the past several years. How should blockchain developers be regulated? What legal protection should consumers have? How should stablecoins operate? What happens when a crypto company files for bankruptcy? What rights do individuals have to hold their own digital assets? And perhaps the biggest question of all, which regulators are actually responsible for overseeing this rapidly evolving industry? Instead of leaving those questions for courts to answer one lawsuit at a time, lawmakers are attempting to establish a comprehensive structure that businesses, investors, developers, and financial institutions can understand. Because without a predictable framework, long-term investment becomes significantly more difficult. But here's where it gets interesting and spicy. The Clarity Act isn't simply about crypto. It's about Americans' position in the global financial system. Let this sink in, ladies and gentlemen. This is so important. Countries aren't just competing over digital currencies anymore. They're competing over where the next generation of financial infrastructure will be built. See, history reminds us that transformative technologies almost always arrive before governments know how to regulate them. One of the clearest examples occurred during the Industrial Revolution with the rapid expansion of America's railroad network. Railroads connected cities that had never been economically linked before. Goods moved faster than ever. Commerce exploded. Entire industries were transformed overnight. But the legal framework struggled to keep up. Questions about interstate commerce, competition, ownership, and oversight became increasingly complex as the technology expanded. See, for years, uncertainty slowed investment. Only after Congress established clearer regulatory standards did railroads evolve into the backbone of American economic growth. That technology hadn't changed. The tracks were already built. The trains were already moving. What changed was confidence, baby. It's all about confidence. That Gucci conviction, that Gucci clarity, confidence. Businesses finally understood the rules. Investors understood the risks. Capital flowed more efficiently because uncertainty began to disappear. Crypto may be approaching a remarkably similar moment, but blockchain technology already exists. Digital assets already move billions of dollars every day. Financial institutions already understand the potential. What many have been waiting for isn't better technology. It's regulatory certainty. That distinction matters because markets often react to headlines. Institutions usually react to structure. Short-term noise, long-term structure, ladies and gentlemen. See, one of the strongest signals emerging from negotiations is that many of the industry's most important priorities have remained intact throughout the legislative process. Despite extensive debate, several foundational provisions continue to form the core of the bill. Let this sink in. This is massive. Among the most significant are protections for blockchain developers. For years, one of the industry's biggest concerns has been whether simply writing blockchain software could expose developers to the same regulatory obligations as companies that actually hold consumer funds. That's massive. The Clarity Act attempts to draw a much clearer distinction. Developers building non-custodial software and blockchain infrastructure would not automatically be treated as money transmitters simply because they create or maintain decentralized technology. Let this sink in. See, that might sound like technical legal issue. In reality, it could shape where blockchain innovation happens over the next decade. Software developers create the infrastructure. Entrepreneurs build businesses on top of that infrastructure. Investors fund those businesses, and institutions eventually integrate the successful ones into the broader financial system. If developers face excessive legal uncertainty, innovation often moves somewhere else, unfortunately. We've seen that pattern repeatedly throughout the history of technology. Talent follows opportunity. Capital follows talent. Innovation follows certainty. Now, this is what most people miss, unfortunately. This provision isn't designed to eliminate regulation. No. It's designed to ensure regulation applies to the activities regulators actually intend to oversee. There's a significant difference between writing code and taking custody of customers' assets. The legislation attempts to recognize that difference. See, while developer protections focus on innovation, another major section of the Clarity Act addresses one of the fastest growing areas of digital finance, stablecoins. Stablecoins have quietly become the bridge connecting traditional finance and blockchain technology. Unlike more volatile cryptocurrencies, stablecoins are designed to maintain relatively stable value, making them useful for payments, settlements, remittances, and institutional transactions. For many banks and payment providers, stablecoins represent one of the most practical real-world applications of blockchain technology. The legislation establishes a clear regulatory framework governing how these assets operate. Among the provisions attracting significant attention are rules, preserving the ability for regulated stablecoin models to support yield-related activities while removing earlier proposals that many feared could slow adoption. Just as importantly, the legislation reinforces compliance requirements that many financial institutions view as essential. Stablecoin issuers would be expected to comply with lawful government orders involving the freezing or seizure of assets when legally required. That requirement may generate debate among decentralization advocates. But for banks, payment networks, and institutional investors, compliance mechanisms often represent a necessary condition for participation. It's a balancing act. Encourage innovation, protect consumers, support financial stability, and create enough legal certainty for institutional capital to participate with confidence. See, that balancing act runs through nearly every chapter of the Clarity Act. And perhaps nowhere is it more evident than the section focused on one of crypto's most fundamental principles, the right to control your own digital assets. See, for many people outside the crypto industry, self-custody may sound like another technical term. In reality, it's one of the foundational ideas that gave birth to cryptocurrency in the first place. The ability to hold your own digital assets without relying on a bank, broker, or centralized exchange has always been one of the blockchain's technology's defining features. Supporters argue that if individuals truly own digital assets, they should also have the legal right to control them directly. That's exactly why Keep Your Coins provision have attracted so much attention. Ladies and gentlemen, we'll write this down. This is so important. The legislation reinforces the principle that Americans have the right to hold their own cryptocurrency without unnecessary interference. To many investors, this isn't simply about convenience. It's about financial sovereignty, the ability to decide where your assets are stored, the ability to eliminate third-party counterparty risk, the ability to participate in decentralized finance without surrendering control of your holdings. After years of debating surrounding wallets, exchanges, digital ownership, placing self-custody directly into federal legislation would represent one of the most significant acknowledgments of individual crypto ownership the United States has ever considered. This is so important, ladies and gentlemen. You got to really take this in. You got to marinate on what I just said. But that's only part of the story, ladies and gentlemen. See, because if the last few years taught the crypto industry anything, it's that self-custody isn't just about security. It's also about what happens when companies fail. See, the collapse of FTX fundamentally changed the conversation surrounding customer protection. Before the collapse, many investors assumed their digital assets remained their property regardless of where they were stored. Reality proved far more complicated, unfortunately. As bankruptcy proceedings unfolded, countless customers discovered that ownership structures inside centralized exchanges were not nearly as straightforward as they had believed. Years of litigation followed. Questions emerged about customer claims, asset recovery, priority rights, and how digital assets should be treated inside bankruptcy courts. See, the Clarity Act attempts to address those concerns directly. Under its proposed framework, customer assets would be more clearly separated from the company's own assets during bankruptcy proceedings. That distinction could significantly reduce the uncertainty consumers face if another major crypto platform experiences financial distress. Think about the broader message this sends. Institutional investors don't only evaluate returns, ladies and gentlemen. They evaluate legal risk, operational risk, counterparty risk, bankruptcy risk, creating stronger protections around customer assets. Doesn't guarantee failures won't happen again. No. Markets will always involve risk. There's risk getting out of bed every day. You get run over by a car, unfortunately. Someone goes and plays the lottery. How these things happen, who knows? Companies can still make poor decisions, but stronger legal protections create clearer expectations when things do go wrong. And clarity builds confidence. Confidence encourages participation. Participation attracts capital. Participation is sexy, ladies and gentlemen. Remember that. Capital drives innovation. That's one of the recurring themes throughout this legislation. It's not simply attempting to regulate crypto. It's attempting to create an environment where responsible participation becomes easier for everyone involved. But here's where the conversation takes a dramatic turn, ladies and gentlemen. Despite broad agreement on many of the bill's major provisions, one issue continues to dominate negotiations in Washington. Ironically, the biggest obstacle facing the Clarity Act isn't centered on blockchain technology. No. It isn't about Bitcoin. No. It isn't about XRP, the anointed one. No. It isn't even about stablecoins. The central political battle revolves around enforcement. Specifically, who should have the authority to enforce the new rules? One side argues that enforcement should remain primarily within the Department of Justice, creating a more centralized federal approach. The opposing view supports giving state attorneys generally a larger role alongside federal authority. At first glance, that might sound like a procedural disagreement. In reality, it represents a much deeper philosophical debate. Should crypto regulation be enforced through one consistent federal framework, or should individual states retain broader authority to pursue enforcement actions independently? Both sides argue their approach strengthens accountability. Supporters of broader state involvement believe additional oversight creates stronger consumer protection. Opponents worry that multiple enforcement authorities could recreate the same fragmented regulatory environment the industry has struggled with for years. It's a debate about consistency versus decentralization, efficiency versus redundancy, federal uniformity versus state flexibility. And while it may appear technical, this single issue has become one of the most important negotiating points surrounding the entire bill. Because legislation isn't only shaped by policy, it's shaped by politics. Every vote matters. Every amendment matters. Every compromise matters. Sometimes the future of a major piece of legislation comes down to resolving one remaining disagreement. And that's exactly where lawmakers now find themselves. See, timing has become almost as important as the legislation itself, ladies and gentlemen. Congress operates within limited legislative windows. As lawmakers approach recess, election cycles, and broader budget negotiations, opportunities to move major legislation become increasingly narrow. That's why so many attention has focused on the weeks leading up to the Senate's August recess. If lawmakers can build enough bipartisan support before the deadline, momentum remains on the bill's side. If negotiations extend beyond that window, attention could swiftly shift towards other priorities competing for floor time. Government funding, election campaigns, economic policy, international developments. History shows that legislative momentum is difficult to regain once it slows. That doesn't necessarily mean a bill fails. No. It often means longer negotiations, additional amendments, and greater uncertainty. And uncertainty is precisely what this legislation is trying to eliminate. Reports surrounding the negotiations suggest that many of the industry's most important priorities have remained intact despite ongoing political debate. Developers' protections remain. Stablecoin provisions remain. Self-custody protections remain. Bankruptcy safeguards remain. The overwhelming majority of framework appears to have survived negotiations. The remaining disagreements are increasingly focused on how those rules will ultimately be enforced. That distinction is so important, but it suggests that the debate has shifted away from whether crypto deserves a regulatory framework to how the framework should function. That's a meaningful evolution of conversation, and it's what many industry participants have been waiting years to see. See, history offers another remarkable example of what happens when legal certainty finally catches up with financial innovation. See, following the Great Depression, confidence in America's banking system had been severely damaged. People questioned whether their deposits were truly safe. Banks failed in waves. Fear spread faster than confidence. The introduction of federal deposit insurance didn't eliminate every financial crisis that followed, but it fundamentally changed expectations. It created a framework people could understand. Consumers knew where they stood. Banks understood the rules. Confidence gradually returned, not because every risk disappeared, but because uncertainty was significantly reduced. Crypto today faces a different challenge, but the underlying principle is surprisingly similar. Technology alone doesn't create widespread adoption. Confidence does. Legal certainty does. Clear rules do. Prices reacting, systems evolving, and that evolution may ultimately prove far more significant than any single day's movement on price charts, because institutions understand the rules of the game. They're finally able to decide how and where they want to play it. That's massive. So where does XRP fit into all this, you're asking, Dom? The answer is both straightforward and incredibly significant. The Clarity Act doesn't create a special category for XRP. It doesn't hand Ripple a competitive advantage, and it doesn't guarantee any particular outcome for the asset itself. What it does is something arguably even more important. It creates a regulatory environment where companies that have invested heavily in compliance may finally be able to operate with far greater certainty. See, for years, Ripple has consistently argued that blockchain technology should exist within a clear legal framework rather than outside of one. While many companies focus primarily on rapid expansion, Ripple spent years engaging with regulatory financial institutions, payment providers, and governments around the world. That strategy often attracted criticism. Some believe regulation would eventually become irrelevant. Others argued decentralization alone would solve every challenge. But over time, one reality became increasingly difficult to ignore. Large financial institutions don't move billions of dollars based on hope. They move when legal responsibilities become clear. Banks answer to regulators always and alone. Asset managers answer to regulators always and alone. Payment companies answer to regulators always alone. Public companies answer to regulators always alone. If the rules remain uncertain, adoption often slows. Not because the technology lacks value, but because compliance departments simply cannot approve participation without understanding the legal framework. That's why regulatory clarity matters, not because it guarantees adoption, but because it removes one of the largest barriers standing in its way. Retail investors and institutional investors often look at the same news through completely different lenses. Retail traders frequently focus on today's price movement. Institutions focus on whether an investment can fit inside a long-term regulatory framework. These are two entirely different conversations, ladies and gentlemen. This is massive. Let this sink in. Imagine managing hundreds of billions of dollars on behalf of pension funds, insurance companies, or sovereign wealth funds. Every investment decision passes through legal reviews, compliance reviews, risk management, committees, operation due diligence, broad oversight. One unanswered regulatory question could delay an investment for months or prevent it altogether. That's why legislation, like the Clarity Act, extends far beyond crypto enthusiasts. It provides institutions with something they value almost as much as returns: predictability. The clearer the framework becomes, the easier it becomes for traditional financial institutions to evaluate digital assets using the same structure process they already apply to every other asset class. This is paramount as far as I'm concerned. That doesn't mean every institution suddenly embraces crypto. Far from it. But it means conversations that once ended because of uncertainty may finally continue based on fundamentals instead. That's a subtle but important shift. There's an old observation often attributed to Mark Twain. History doesn't repeat itself, but it often rhymes. Think of the Clarity Act as constructing the legal foundation beneath a rapidly growing city. Skyscrapers may already be standing, businesses may already be operating, people may already be living there, but without reliable roads, utilities, property rights, and public infrastructure, long-term growth eventually slows. The infrastructure isn't always the most exciting part of the development. It's rarely what captures headlines. It is often what determines whether a city continues expanding for decades or struggles under its own uncertainty. Financial systems work in much the same way. Innovation captures attention. Infrastructure sustains progress. For years, the crypto industry has built extraordinary technological infrastructure. Now lawmakers are attempting to build the legal infrastructure around it. Whether every provision survives exactly as written remains to be seen. Legislation almost always involves thorough negotiations. Amendments happen. Compromises happen. Political realities shape final outcomes. But the direction of travel has become increasingly clear. The conversation has shifted from asking whether digital assets deserve regulation to determining what the regulation should actually look like. That is a profound change. As investors, ladies and gentlemen, it's easy to be consumed by daily price charts. Green candles generate excitement, dopamine. Red candles generate fear. Social media amplifies every headline, every rumor, every prediction. But lasting financial transformations rarely happen overnight. Let this sink in. It's like watching the paint dry on the wall, ladies and gentlemen. They happen one framework at a time, one policy at a time, one institution at a time. Clarity Act may not instantly transform the crypto market. It may not immediately change prices. And it certainly doesn't eliminate every challenge facing the industry. What it could do is establish the kind of regulatory foundation that allows innovation, investment, and institutional participation to develop with far greater confidence than before. For XRP holders, the significance isn't about receiving special treatment. No, it's about operating within an environment where regulatory expectations become clearer, legal uncertainty begins to fade, and financial institutions can evaluate blockchain technology using consistent rules instead of conflicting interpretations. That's the bigger picture. Short-term noise, long-term structure. Prices reacting, but the system's evolving. And sometimes the most important developments in financial history aren't the ones that create the biggest headlines today. They're the ones that quietly reshape the foundation of everything that comes next. Why tell you pay attention to what's quiet? Ladies and gentlemen, if you found this breakdown valuable, make sure to subscribe to the channel and turn on notifications, because we'll continue following every major development surrounding the Clarity Act, digital asset regulation, Ripple, XRP, and the broader transformation of the global financial system. Thank you for watching, and I'll see you in the next one. Hope everyone's having a blessed Friday, everybody. A lot to go over. I'll be real fast. I want to welcome all the members of the Crypto Public Desk Monthly, all the new members of the membership channel. And I want to give a belated happy birthday to Big Mike. We love you, Big Mike. Happy belated birthday, brother. Well, at this point in time, the markets are down. XRP, ICP, HBAR, XLM. We're square all positions right now ourselves because it hit all our price targets. The market will now be pushed by Big Daddy O dollar. It will tell the story. Ladies and gentlemen, the last time this conflict sparked up and went kinetic, investors and traders inside the Crypto Public Desk Monthly saw gains anywhere between 50 to 300% on their money, depending on what calls they decided to take. If you want to take advantage of what's happening and join over 620 active traders and investors who are learning to trade and navigate all of this and have their hands held, come and join the Crypto Public Desk Monthly. We take the PhD out of PhD with this, and we're just as excited right now for the chaos. You got to find the silver lining in every cloud. But the moves that are going to happen in oil, metals, silver, and a whole bunch of other things that no one pays attention to, what we do, we're paying attention to this. But right now, as DXY goes higher, the yields on mortgages moving higher, people are getting cut up like sushi, carried out like body bags. You got to have that Gucci conviction, that Gucci clarity in now. You got to understand why you're in this now. Also, the first podcast in the Crypto Republic Desk Monthly went out. It's free for everybody inside the Crypto Republic Desk Monthly and the Patreon. It's free, the first episode. So if you're on the Patreon, do look for that. But ladies and gentlemen, understand this right now. There's two thoughts right here. Does the United States have enough munitions, interceptors, long-range missiles to deter problems in the Indo-Pacific to continue going through this? That's one school of thought. The other school of thought is there a more massive attack happening with the Houthis now from their part of occupied Yemen to threaten the Red Sea naval blockade. Ladies and gentlemen, this will affect crude oil. Crude oil affects inflation. Inflation affects everything. We are not in the camp that Mr. Wall will raise interest rates. When the market understands that the boogeyman of this goes away, the rip your face off rally begin. XRP. Ladies and gentlemen, I gave a really hysterical analogy before to a massive family office and the family that was concerned about XRP's price movement. They said, what are my viewpoints? I said, I'm more excited than ever. I love this game. Volatility is the friend of the long-term accumulating trader. Are you crazy? I said, this is not a time to lose that Gucci conviction, that Gucci clarity and cut up like sushi. To me, XRP's moment's coming. The Clarity Act is going to get passed, I said. And when that happens, people are going to look back to this point and say, my God, I should have got what I needed for my own thing. None of this is financial advice and any capacity. It's my own opinion. Again, anyone takes any capacity, none of this is financial advice whatsoever. But this is when you can't have your nerves shaken out. So as of right now, why XRP? Why not? It benefits from this. Russia passed laws. India wants more action with the BRICS and the unit. It's happening, ladies and gentlemen. The United States of America on the west side of the Trent is not going to cede control of the crypto space to anybody. Okay? They'll get this done. They'll figure a way through. That's what happens, and it will. But XRP's moment is coming, ladies and gentlemen, and ICP as well. To me, I look at blockchain as the final frontier. I've been digging things out of the ground for the last 20 years, developing refineries and physical concessions, a part of the world that nobody can even pronounce, let alone walk into. This is the most massive concession ever. The blockchain concession. Don't FOMO this. Remember why you work that extra job. Remember what your goals are. I go over this in the Zoom call always, ladies and gentlemen, every week. If you want to be in the Zoom call, join the Crypto Public Desk monthly. I love helping people, but understand this. The moment's coming. So right now, all the markets are moved by DXY, and it's going to be moved by a broader hostility attack. We're in the camp that a larger attack is coming. But there's got to be a time when you go into cash and you wait for the accumulation zones and targets. If you want to see the accumulation zones and targets for everything we're following, come and join the Crypto Public Desk monthly. See how we are taking advantage of it. See why 620 active traders investors are. Because it's not so hard once you're following everything here. But if you're at the point of this video, you should subscribe to the channel and join the Patreon. Whether the free version is the best version, you'll learn something here. Because at the end of the day, what will continue is his chaos, the tweets, the narratives, the crude oil shortages. That will affect XRP, ICP, HBAR, XLM. It's going to. But we're in the camp as the financial mercenary that understands why people are doing what they're doing. Before, we were in position waiting for this to happen. If you're watching all these videos, you can see. But again, DXY, retaliation. This is going to fuel all the markets right now. Don't think people are going to put things to work, whatever. But volatility is the accumulation trader's friend. I love you all, ladies and gentlemen. I'll see you on the front lines. Ladies and gentlemen, these videos are for educational entertainment purposes only. It's not financial advice. Always consult your licensed financial advisor, always. Never, ever invest any money based on watching a YouTube channel, ever. Never, never, never do that. But ladies and gentlemen, here's the candy from Italian Ice. The more the chaos comes, the more predictable the plays become. And if you want to enjoy the predicted of these plays, come and see us in Crypto Public Desk monthly. Crude oil affects the DXY. DXY affects crude oil. DXY affects gold and silver. That's the name of the game. Affects crypto. I love you all. I'll see you on the front lines.